Good afternoon and welcome to this edition of Finweek Money Matters, the show that helps you manage your finances. I'm Nozi Pombanja. Of course, my co-host is Marc Ashton, editor of Finweek, and Kristia van Heerden, Finweek.com editor. Coming up on the show today, we discuss how 4 entrepreneurs raise funds to start their businesses. We then discuss the fourth quarter consumer credit index and the residential trends for 2014. Remember that you can read more about these stories and many others in this week's edition of Finweek on shelves from today. The magazine is also available digitally in English and Afrikaans via mysubs.co.za. We would like to hear from you from your place or your place of work or home. Please do call us to give us your market and investment related questions. The number to call is 011-384-0598. That's 011-384-0598. In its cover story this week, Finweek chats to 4 entrepreneurs about how they raise funds to start their businesses and the various avenues available to them. Joining me on the desk is Chris Bischoff. He's the developer of Stasis, and Sonia Gilder, manager at Pre-Investment Business Center. Thank you so much for making the time to join us. Sonia, let's perhaps start off with you. When we look at, when you are at the IDC and you are dealing with entrepreneurs with their business ideas coming in looking for funding, do you find that they have an understanding and have their finger on the pulse of how much capital they actually require for the venture they're about to take?
Sometimes they do, which is very heartening for us, but in most instances they don't. I think many entrepreneurs, when they start a business, they tend to sell themselves short on how big they can grow their market, but also then how much funding is required. I think many people don't realize that you need money to make money. And we talk about working capital requirements, and most people sell themselves or cut them short on that.
So one of the things that I find when I start talking to entrepreneurs is often that they don't have a grasp of what are their finances, or of what actually is needed when you run a business, and it's working capital, it's cash flow, what is the income statement, what are their assets. When you look at an entrepreneur, how important is that when you're actually assessing their criteria?
It's extremely important. If they do not know their own cash flow, their cash flow requirements and what they have available, it's very difficult for them to manage the business, firstly. Secondly, they could run into issues when they grow their businesses and run out of cash. And thirdly, it's very difficult for a financier to finance them if they don't have an idea as to what they require. We normally have a saying, specifically in IDC, we finance people, not necessarily businesses.
But that's a fair point then, because what about the needing of a financial manager or FD, somebody who's actually got a grasp of it? I mean, it's easy to go and get these template-driven business plans that you can kind of stick some numbers into, but real understanding of it. If you look at a business or a team that comes to you and they don't have somebody with finance skills, does that black mark against them?
It does not black mark them, but what we normally ask them to do is to undertake to appoint someone to help them through these things, because it's extremely important. I mean, the financial side of a business is so important for the financiers and everyone. What we also suggest for them to do is to use their auditors in the beginning, especially if sometimes they can't find someone in time or things like that, or they can't afford it. And then we normally suggest to them to just use their auditors.
So Chris, one of the things that I found quite interesting looking at the makeup for this article, very few people went to banks to go and get money. And look, I think there's a bit of distrust of banking institutions in general, because I think there's an idea out there that banks don't lend and support entrepreneurs. Why didn't you go to a bank for funding?
The big thing with us is that because our business was so new and so niche, we honestly weren't certain if we could actually get kind of banking finance. But there's also a thing with Kickstarter as well, is that it actually gives you direct contact with the audience that you're trying to actually sell your product to. And I mean, that in itself is something that a marketer would dream about. I mean, imagine being able to finance a business with 4,500 people that are actively involved in your project and really want that project to succeed. I mean, you can't buy that sort of support. Well, you obviously can at Kickstarter, but I mean, that sort of thing is like a bank can't actually offer that. A bank can offer the finances, but what crowdsourcing allows us to do is finances as well as the support of the people that are going to be using your end product as well.
Can we maybe talk about how you decided how much money you'll need?
The Kickstarter was quite different for us in the way we did it, in that usually what people do is they actually look at the money and they say, okay, we need $50,000 or $100,000 to actually do our product. And what we did is we looked at this as sort of like, if we were going to start this as a business, how much would we actually need? So we had to see if I'm going to take off a year of work from my company, which I am a managing partner in the company, what would the amount of money be needed to actually make this a viable thing for us to actually do? So, you know, we could have raised $20,000 and been like, well, this is fantastic. You know, I've got enough money to keep me going for the next year on, you know, ramen noodles and water. But I mean, at the end of that year, if I've only sold $20,000 worth of product, it's not a viable thing for me to go and say, well, now this is going to be the next 5, 10, 15 years of my life. So we looked at it not only in terms of how much the game was going to cost to actually continue to produce, but also what would be a viable amount of money that we could go and we could say, if we got $100,000 and we then sold the game and we sold 4 or 5 times the amount of money that we'd actually need to really continue this as a lifestyle business to actually go forward. Yeah.
Sonia, I mean, one could always argue that for a business that is product orientated, if they were to have advance orders, perhaps that would be a good test of the validity of their idea and whether it has any attraction to the market. Do you look at that as an indicator before you make the final decision to partner or fund a specific project?
Yes, definitely. But bear in mind, we do finance different industries. So in some industries, you won't be able to have that. For a venture capital kind of industry, you might not have contracts in place. For existing businesses and things like that, it is much easier for a financier to say, yes, I believe in the viability of this business if there are contracts in place.
So I'll put you on the spot then here. You've just heard Chris's pitch, and he said he's gone to a Kickstarter type initiative to get money. Does it worry you that he's gone to them rather than to an organisation like the IDC? And then I guess as a follow-up question, has in 5 minutes chatting to Chris, do you think he's got enough business attributes that you'd be interested in backing him?
Do you have interest in Chris's business by any chance?
I think it's a good question.
Okay, let's start with the first one. No, I'm not worried that he went to a startup for finance, because they are better geared in most instances to validate these kind of things and to have a look at it. That's a venture capital type of industry, and we do have a venture capital industry and business unit in RDC, but it's very difficult to gauge. So for us, it's not an issue if people start off with other financiers. Later on, as soon as he's into it a bit more, and like you mentioned, contracts and things like that, then it's easier for RDC or other bigger financiers to just step up.
Sorry. The issue with the IDC, I find, or I've heard, is that you require so much preparation before you can actually approach the IDC. You need a business plan. You need to know exactly how much money you're going to get, as Marc mentioned. For a company like Chris's company, isn't the barrier to entry a little bit too high at the IDC?
We've had many comments like that, and what we've tried to do in the last 3 years, we started the Pre-Investment Business Centre just under 3 years ago, and we've tried to sort of breach that gap, because what we have found is that people don't necessarily know what kind of business plans they need. So we've now really given a whole list of things of what we require. We've also built a tool on our website where people can go and build business plans and things like that. But we also try and encourage them to come and talk to us. We have an initiative with NYDA and CFA where we actually help people with our consultants to build business plans and things like that.
Sorry, Marc. I mean, oftentimes when one reads stories about entrepreneurs, it always seems as if the passion always comes before the need for funding. So the heart goes up first. I mean, did you have that experience? And once your passion had to deal with the rand signs that you actually needed, was it a sort of come back to life moment, or had you always been parallel with both?
Well, I mean, Stasis, I've worked on it for 3 years in my spare time, afternoons and weekends, before we even got to a point where we were like, well, it might be a viable product for people to actually go do it. So I mean, essentially, it's a hobby project. It started as a hobby project, very much a passion-based project. I mean, you don't work on something for 3 years and then sort of, kind of put it to the side afterwards, sort of thing. So it was definitely a project that it had a massive foundation laid for it before we even considered actually going and finding external funding for it. And I think that really came through in how we actually manage the fundraising part of the campaign. And I think that sort of, if it was a case of just doing something to make money, it wouldn't have actually worked. I think that people, especially in the crowdfunding industry, respond mostly to passion more than anything else.
Okay, so Sonia ducked my second question, so I'm going to give you the opportunity to respond. Has she done enough to convince you that the IDC would be an organisation to approach if you were to go and look for your next? And I appreciate it's a short-term discussion, but I'm just saying, like, there's this perception out there, trying to do business with the IDC is hard. Would you consider it going forward?
Yeah, to be honest, if Kickstarter hadn't actually worked, we would have gone with some sort of venture capitalist, some sort of angel investing, perhaps even the IDC, if it went that way. The sort of the large sort of question that we have to actually ask ourselves is, although now we actually are accountable to a lot of people, we've got 4,500 backers, it might actually be up to about 5,000 with the external funding. It's actually almost an easier burden to bear knowing that I owe somebody $20 instead of knowing that I owe an organization 1.5 million rand. So in that case over there, it's actually, it sort of takes a bit of pressure off of the person who's actually starting a business. I think going to a bank, going to the IDC, going to any sort of angel investor or venture capitalist does have an extra sort of sword of Damocles hanging over your head of, if this doesn't actually work, how am I going to get out of it? Which I think is much easier. But I mean, it's definitely not something that we discounted outright, but it was a case of let's try the Kickstarter, try crowdfunding. If it doesn't work, then we'll look at the alternatives.
And then Sonia, do you think that the risk has, you've just heard that, and I think this is a concern for entrepreneurs, is it's scary to borrow money from somebody. Has the risk appetite from South African entrepreneurs changed enough that they are actually prepared to take that risk over, let's say, the last 5 years?
I think it has. If you look at from 2008, we've really had depressed situations, and yes, people have actually come for more funding because I think they've realised that you have to weigh the scary part of having the finance with. You've got to what's that word?
Reward, risk and reward.
Risk and reward, but also you've got to debt and equity. You have to gear your company properly.
Sure.
Yeah.
I mean, let me throw another question at you, Sonia. I mean, when we look at entrepreneurs that the IDC works with, I would assume that when you're looking at startups, you use a somewhat different framework than those that are looking to expand looking for finances to expand their businesses. Talk us a little bit about the key differentiators that you apply or how you look at them before you advance funding.
Sure. If you look at our processes and things like that, it's not necessarily different, but we have, on every single deal that we do, we have due diligence teams. My team is involved before they go on due diligence, so my team would work with the entrepreneurs and we'll see who needs more assistance and who won't. So we will assist the startups a bit better to say, look, let's help you a bit with your business plan. Let's give you a consultant if not necessary. We do prefer that people do their own business plans. It is better, they take ownership, they know what's going on, and we need them to know what's going on.
Can you tell us what you look for in a business plan? What are the key indicators of a good business plan?
Well, a good business plan speaks to about, at least 4 things. Firstly, your market, where you are currently, how you're going to go to get there. Secondly, your technical side. So what do you have? What kind of equipment do you have? If you're manufacturing, what kind of other systems do you have? Thirdly, financial, very important. Where are you? Where are you going? How are you going to do that? And then management. We basically finance individuals or people.
Financing people. Unfortunately, we're going to have to wrap the conversation on that note. Thanks to our guest, Chris Bishop, developer of Stasis, and Sonia Gilder, manager at Pre-Investment Business Center. Time now for a quick look at our Finweek Trade of the Week. This week's Trade of the Week is Capital Property Fund. Mark, of course, we see their distribution increased by 8.37%, but most specifically, this is one of the companies that is actually making a good return on the basis of a weaker rand. So your views on that? Yeah,
look, I think property is an interesting one at the moment. I think interest rates have certainly changed the mix for domestic property. In fact, a lot of the interest is actually in offshore property at the moment from an investment perspective. I read through the ProPick, which was the Catalyst Fund Managers picking capital property funds, and one thing that was really interesting was just that the type of properties that they're investing in. I think there's a lot of interest. There has been historically a lot of interest in commercial property and the shopping centres, but economically they're not a great place to be at the moment. The rents are expensive, tenants are struggling. It's not a great place to be. Capital's a little bit more niche in that they've got a lot of nice industrial properties. So for me, I quite like the fact that they're a little bit different, a little bit more focused. They've got a nice portfolio. They haven't tried to just bundle a whole lot of stuff together. They've got a niche that they've cut out for themselves.
Would you then say that, I mean, there's a lot of conversation that in addition to the fact that this interest rate was unexpected, that there's likely going to be another one in the near future. If we look at the trends with other emerging markets and the reaction that they're having to the crisis that's facing these particular markets, in light of that, where would you put Capital Property Fund? Would you say, it's likely to show even greater returns in future?
Look, I think it's very difficult to say. I mean, listed property had a bad year last year, and it's probably not going to be a great year from a capital gains perspective. Distributions are important for the property, and at the moment, if you can still beat inflation with 6 or 7% dividend yield or distribution yield, I think it's not a bad investment at the moment.
So your final recommendation on this one?
Just like I got, hoping that I can point. I want to point back to last week where I said short able, because you've been making some nice money this week. I think this is a nice long-term hold.
A nice long-term hold. Time to pay the bills. We'll be right back after this short break. Welcome back. Now, Transunion is releasing its fourth quarter consumer credit index today. Here to unpack and share the latest findings of the index are Jeff Miller, CEO of Transunion, and Russell Lamberti, strategist at ETM Analytics. Gentlemen, thank you so much for making the time to join us. Perhaps, Jeff, let's just start off with the purpose of the index. Why do we do it, and where does this data go?
Yeah, I think it's, well, the reason we did it is because we think there needs to be basically an overall assessment of where the consumer credit market is in South Africa, how healthy is it, and that, gives a sense for, not where the economy is going. Obviously, our customers are banks and retailers and telecommunications companies, and they want to know kind of where things are going, and so, we partnered with ETM to try and bring that to the market.
Yeah, Russ, I mean, I was just chatting to one of the producers off air here, and we were talking about status of the South African consumer, and the general media response to the interest rate increase earlier this week was it's about $300 extra if you got a $1 million rand bond. But I look at my own social circle and I just get the sense that South African consumer is really under pressure at the moment. Maybe give us some context as to what your expectations are there.
Yeah, I think you're right. On the whole, it's important to understand, of course, that there's a wide array of consumers. There's different buckets of consumers, if you like, different income groups. People experience price increases, interest rate increases in very different ways, and so certainly there's a portion of South Africa, perhaps people who've gone too far in over their heads with perhaps unsecured lending, who are certainly under pressure, and I think there's a lot of your kind of middle to lower middle class income, middle income consumers that are just looking at, particularly in Gauteng, things like e-tolls, petrol prices going up, that are definitely weighing. And what an interest rate hike does is, at the margin, just exacerbates that effect a little bit. So certainly we're seeing that. But I think there is also evidence that there are certain sectors of this market that are actually doing okay. That people who are perhaps slightly higher income, who own home assets that have appreciated in value somewhat, who've paid down their debts. So it's not a blanket bad story for the South African consumer, and I think that's important.
Jeff, if we're to go back to the key findings, if you can talk us through them, one of the biggest trends that are coming out, what are these?
Yeah, I think there are one or two things to take away from it. I think it did go up slightly. The index improved slightly, but not a necessarily great thing. So consumer debt or consumer delinquency was rising 13% last quarter on a year-over-year basis. This quarter it's rising 8%. So more people are not paying their bills, but it's less than it was last quarter. And I think a lot of that has to do with lenders have pulled back, and it's not just a recent event. They've been pulling back now for over a year. And so you're having less credit issued into the market, and so less new credit means less delinquencies, but there are still, especially in the low LSM sectors, there's just people that are underwater.
Why is it that the household cash flow situation has improved, but consumers haven't been able to pay off their debt? Why isn't there a correlation there?
Go ahead, Russell.
Yeah, perhaps just to say, I think that household cash flow is to the extent that we think it's improving. I think that it's off a pretty low base. I think people are under a lot of pressure. We saw in the fourth quarter the official inflation statistics showing that on the whole, necessities for households didn't actually increase in price by that much. But if we look forward, we're a little less sanguine on that outlook. We think that with the weak rand, with petrol prices increasing, we think that even food prices are going to just start to increase a little bit more. So I wouldn't read too much into the improvement in household cash flow. I think that if we just take a slightly forward-looking view, pressure remains in that space.
So how does the South African consumer in terms of debt compare to consumers around the world? Are we doing pretty well, or are we faring poorly? Because I read that some people have debt of up to 75% of their monthly income. That's staggering.
Well, again, I think there's you got to look at the broad array of consumers. There are some consumers, as Jeff has just said, that are underwater. Some people are so in over their heads that they're actually defaulting, and that they're going through a process of debt counselling and so on. But if we look at South Africa as a whole, true to our nature, we kind of seem to straddle the developing world and the developed world. Our debt levels at a household level aren't as high as they are in Europe or America or the UK, but at the same time they're way higher than our African peers, for example, and other emerging markets. So that's kind of where we are, which I suppose is where you'd expect us to be. But I think that households in the previous cycle did leverage up a lot, and since then have been spending a lot of time and effort trying to deleverage, trying to pay down their debt, some more successfully than others. So I think we sit with probably a two-tiered story here, where some people, as I said, have actually paid down debt and actually in pretty good financial position, and a whole section of the economy that's not. And that's the dichotomy we face.
What about the products that we are seeing sort of emerging in the market now that we have such highly indebted consumers? For example, like the consolidation of debts and loans in that kind. I mean, Jeff, to what extent are these good tools for consumers to latch onto if they're trying to work down their debt levels, as against just dealing primarily with what they have in front of them?
Yeah, I mean, it depends on the consumer and their, and I guess their financial discipline. I mean, the product in itself isn't necessarily a bad product, but what I would say is consumers that are used to 30-day loans, 60-day, 90-day loans, taking out a 60-month loan is a real big step for them, and I don't think they've necessarily understood that consequence. And also, let's be honest, it's at a very, very high interest rate, and many consumers don't equate or don't understand the interest rate they're paying. They only equate the monthly repayment amount that they have.
Right.
And so you have actually consumers that are taking out personal loans to purchase automobiles. And in my view, that's not a wise thing to do, because you can go get a vehicle finance loan at a much more attractive rate.
I mean, one of the things I find quite interesting, and I don't know, and to Russell's point about there being two very different economies, how much are you impacted by asset appreciation in things like the stock market? So we've get this great run in the market, but let's say it fell by 10 or 15% over the year. Would that change your index much in terms of, I guess, the ability to service the debt and the outlook for them?
I'll let Russell answer that one.
I think it's a complex question in a way, because so many of these things are interconnected. But a falling stock market wouldn't necessarily directly impact the index, but what you're likely to see in this phase of the cycle, and we've begun the process essentially, is interest rate hikes. That starts to cool the stock market down, and at the same time directly affects debt serviceability and affordability. And yes, there's definitely a net worth effect here that starts to impact perhaps the higher income groups, the stock owners, the people who actually own shares on the market. You lose 10 or 15% on your stock portfolio. That changes your net worth. It perhaps makes you less bold and bolshy to go out and perhaps borrow against some of your assets to buy your second home or whatever it might be. So that's very much that upper tier economy story. further down, I think it's the second and third round effects of a falling stock market. So, we perhaps go into a downturn, the stock market corrects 15 or 20%, that starts to impact certain companies, consumption and investment decisions, and so on. And the guy at the end who gets retrenched starts to come under pressure on his loan, and that's perhaps a 6-month, 9-month story after the market starts to move.
And how long does it take for interest rates to actually get to bite, so to speak? I mean, if you look at the 50 basis points, yes, it's $300 if you're on a $1 million loan, but how long does it take to bite, and then how long is it going to get felt by the index?
Yeah, I mean, it bites immediately in the sense that first monthly payment now is going to be reset.
Yep.
So we mustn't make any bones about that. That happens very quickly in the economy, but these second, third, fourth, nth round effects start to work their way through over probably 12 or 18 months. I suspect that a 50 basis point rate hike, if it were to just be that, and I don't necessarily think that is the case, but if it was to just be that, once it's worked its way through, would probably have quite a minimal impact on this economy at this stage.
Because remember, I mean, it's the individuals with mortgage bonds and with vehicle loans are the ones that are going to feel it. The consumers, that don't have those types of assets or that have taken out personal loans, going from 26% to 26.5%, it doesn't really impact those consumers. But so it's going to be a higher out sums that are going to definitely feel it first.
Jeff, let's look at legislation. I mean, last year we had legislation coming through that seeks to further protect consumers from exposing themselves to more credit. Have you seen the effects of that legislation in the index?
I mean, no, not yet. I mean, the legislation, a lot of it has been discussion and it really hasn't been enacted. In fact, there are parliamentary hearings this week that looked at credit amnesty, that looked at